Jim Stening from FIIG Securities. Jim, good to see you in studio again. Thank you. Now, we've had the interest rate decision this week and, of course, the minutes, and kind of an interesting statement, probably the more interesting of recent times. What did you actually make of the statement and the clues that the RBA was giving?
Yeah, well, it's sort of consistent with their drive to become more transparent. I think I sort of read into that statement that they're in a holding pattern at the moment. I thought it was quite dovish. So yeah, look, I think there's certainly room for rates to rise going forward, but it would seem that a pause is imminent. I suppose what we'll see.
So when you talk, is that from the statement where they said rates are now around average? Was that the key?
That's right. I think that's a really interesting word, actually. Average. It's a new word in
because we debate what average is.
In RBA speak, it really is. I mean, we've talked about neutral monetary policy settings based around a margin over and above inflation, but we seem to have moved to this average historical rate. So we'll have to watch how that develops.
But why did you take that meant they're kind of on a whole? Because if they're talking historically, oh yeah, we're around average, isn't that just a statement? Why do we read so much into that? Isn't it true?
Well, look, it is, I suppose. I mean, what's happened historically, you know, 90-day bank bill rate historically is actually around 5.5 or 5.4. If you take out the emergency settings that we saw last year, it's closer to 5.75. Well, clearly rates are nowhere near that at the moment. We've got a 90-day bank bill rate around 4.75. So there's a sort of a 1%, 75-point margin between the average, rate, 90-day bank bill rate, and where we are now. So what they're saying is that given where lending rates are, they're historically at the average level. So fundamentally, I suppose you could argue that as the economy repairs, those lending rates come in, then short-term rates will need to go up again.
So there is a message in there about lending rates specifically?
There is. I mean, that's what they're focusing on clearly. So they do need to be sensitive to those the access to debt capital for businesses. So
they're trying to say that lending rates are quite high. What does that mean for the banks?
Well, look, I mean, that's the obvious that's the obvious question. I think, you know, the banks are suffering from these increasing cost of funds. I mean, they're borrowers in the market as well, and they've seen their margins that they borrow at significantly blow out as well. So I don't know that there's any sort of offsetting gain. There might be a small amount of pickup in margin for them.
Okay, well, certainly out of the banks that are reporting this week and last week, that's kind of the message that we're getting, that there is that pressure coming through for them. We've got the RBA monetary policy statement, the quarterly statement tomorrow. Is it going to add much to this debate?
Oh, look, I don't think so. I think that you know they're going to be consistent with the recent statement. I think you know, I think the focus will be on statistics as they roll out, as the economy develops over the next few months. Obviously, the situation in Europe will play a role. However, you know, in their recent statement, they didn't pay too much attention to that.
Can I ask you as well about the continuing situation in Greece, and in some ways turning fatal overnight? There's been deaths with all the riots, and people can see obviously that this package, it's hard to get by the people, and of course even the Germans, of course, they still don't like the idea of the whole rescue package for Greece. We've had the S&P chief strategist Sam Stoble saying really the Greek debt crisis significantly raises the risk of a double-dip recession in Europe, and so there's still very deep worries about how it all plays out. What do you say to investors about how you respond to this and the volatility that's coming back into the market because of it?
It's key. I mean, the thing is that it just won't go away. I mean, these issues won't be solved overnight. We are going to continually get downgrades, continually get problems with the fiscal positions of these countries, and so, you know, unless they return to growth in a stellar way, with their cost of funds going up, their borrowing requirements increase. So it's an ongoing vicious circle, and so it really is. It's a developing thing. I don't think it's something that's going to be fatal over the next month or so, but over time it will be. I think, you know, the major thing for me is, and it's a bit of an axe hanging over markets at the moment, is that, excuse me, I think that the UK is in serious peril of being actually downgraded. They're on negative watch. So that's something I think that will have a serious impact on people allocating to risk assets. These are things that are going to be unfolding at all times, and so I think that would be a fundamental concern, should be a fundamental concern for investors.
And we are seeing that flight from risk assets and the move to safety, and I suppose that's where...
That's right. I mean, there's a couple of things that can unfold. Either this is a great buying opportunity for equities and we pile back in and we're off to the races again, Or effectively, this does unfold in a very bad way, and so people should allocate to cash and short-term government bonds. We sort of think that something in the middle is a sensible strategy where you look at credit, say for a good investment-grade company like Telstra or Woolworths or even the banks, where you switch out of the equities into their corporate debt. So you're moving up the capital structure, you're still maintaining an exposure to that entity, but you're getting a guaranteed income stream.
And so, I mean, I suppose for some people the idea of sovereign debt is just, they don't even like the sound of it at the moment, but
yeah, that's right.
Do we paint everyone with the same brush?
Yeah, well, it's some of the commentators or some of the articles that I've read seem to paint sovereign debt with the in a one fell swoop with the same brush. Yes. It's really a function of scrutinising each issuer, and Australia, for example, is in a fantastic position, and I think one of the rabbit that we're going to see come out of the hat with the budget is that we're going to be returning to surplus much sooner than we expected, and so our position where we have over and above our expectations of growth is strong. Our fiscal position is repairing itself. It's a very, very different story. So in terms of Australia's sovereign debt, that's a really, really positive story. So it's a complete antithesis of what we're seeing unfolding offshore.
And just briefly to wrap up with you, I know that before the Henry review you were hoping to see some more incentives for people to be saving and some better tax incentives for deposits. Obviously, with what we've had come through, the big discussion is the super profits tax and the resources. Equities don't like it. We've seen that the last couple of days. The currency's been impacted.
Foreign investors don't like it.
Foreign investors don't like it. Well, Canada loves it. But what about implications for bond markets? Give us your perspective.
Look, it's the same. It hasn't been as dramatic. I think fundamentally what it means is for those smaller issuers or smaller borrowers in the resource sector, they become higher risk propositions. I think, for the larger borrowers, the BHPs, the Rios of the world, well, we've seen rating agencies sort of say that that's not going to have any impact over the short to medium term. But these things need to play out. There needs to be clarity. I think the reaction in currency and equity markets is really about the uncertainty, and so we'll see how it unfolds.
If it hinders economic growth, though, you're looking at an impact on bond markets, obviously.
It will, that's right.
Jim Stening, thank you so much. Great to chat to you. Jim's from FIIG Securities. We're both battling colds, so good of Jim to come in.